Hello everybody. We are going to talk about accounts receivable and what to do when we identify customer accounts that are uncollectible. So as you know, accounts receivable is on the balance sheet and it's an asset. So suppose we have accounts receivable of $20,000 as you see on the screen here. Now we know that $20,000 doesn't represent just one big customer. It's actually the total of a whole bunch of little customers. So somewhere we need to keep up with all of those individual customer balances, and we do that in what's called the Accounts Receivable Subsidiary Ledger. A lot of times we just call this the AR subledger. So as you can see here, I've got a bunch of individual customer accounts listed, and each customer has an account balance. So if you were to add up all of these different customer balances that we have in the subsidiary ledger, all of those would add up to the balance in the accounts receivable account. So in fact, I'm going to double click on that, and you can see that this total in accounts receivable represents the sum of all of these individual customer balances. So we don't constantly refer to the subledger, but it's always there. So that means that anytime you add to accounts receivable by debiting the accounts receivable account, that means that you need to be adding to somebody's account. So for example, if we added $500 to accounts receivable, well, we'd have to record who that relates to. Maybe that's another $500 for Joe. So that means that Joe would now have a balance of $1,000. So remember, anytime you add to accounts receivable, you need to add to a customer balance. And if a customer paid you, and you would be debiting cash and crediting accounts receivable, well, you would need to credit whatever customer that is as well. So again, we don't constantly talk about it, but the accounts receivable subledger is always in the background, and the total of all of those individual customer balances makes up the accounts receivable account balance in total. Accounts receivable is really just one example of an account in the general ledger that has a subsidiary ledger behind it. For example, accounts payable, we need to keep up with who we owe and the individual balances that we owe. So we'll have an accounts payable subledger, and that'll keep up with those individual payable balances that add up to the accounts payable total. Inventory, somewhere we need to keep up with all of the different items of inventory that we have, how many and what they cost us. So we're going to have an inventory subledger, and if you added up everything in the inventory subledger, that would equal the total for the inventory account. So actually, when you think about it, just about every account on the ledger that we've talked about has some sort of detail behind it. For example, the computer that I'm working on right now, somewhere on ACU's campus, they know exactly what computer I have and what model it is. I mean, they keep up with all of those and what it cost. So there's a computer subledger somewhere where they're keeping up with all of that computer equipment, or office furniture, or classroom chairs, things like that. So there's a subledger supporting all of those account balances somewhere. So again, we call that the subsidiary ledger, and the account that we've been talking about in the ledger, that's actually called the general ledger. So we've got $20,000 in accounts receivable consisting of all of these individual customer balances. Suppose we wanted to evaluate the quality of that $20,000. So we know what these individual customer balances are. But so Joe owes us $500. Well, how long has he been owing that money to us? And is all of that brand new, or is some of it old, or whatever? So periodically, you may want to prepare what's called an aging of accounts receivable. So an aging schedule is where you lay out all of the customer balances. So I've got all of these individual customer balances listed here in the total column, and again, that all adds up to $20,000. But then out here, I'm aging those account balances. So, for example, customer Joe, who owes us $500, 400 of that is current, meaning it relates to sales that we made in the last month, and $100 of it is between 31 and 60 days old. We've got another customer here, Rebecca, and she owes us $320 total. 120 is current, 200 of it is between 31 and 60 days old. In this others category, just to kind of lay out miscellaneous account balances, you can see that we have the total amounts that are owed to us just spread out based on how old they are. We have one customer, Clayton, who owes us $200, and that balance is over 90 days old. So it could be some kind of a problem with Clayton. He purchased from us at some time in the past, still hasn't paid us, and when these account balances get old like this, it indicates that we probably need to do some kind of follow-up with Clayton and find out what the problem is. It could be that he never got the bill. Maybe the bill got lost in the mail. Or maybe he is unhappy with the quality of work that we did with him. Or maybe we sent him a product that was damaged or the wrong color or something like that. Anyway, it'd be good to contact Clayton and find out what the problem is. And so when you age the accounts receivable, it allows you to identify where the problem areas are and also to evaluate the overall quality of those receivables. Sometimes you may identify a customer balance that is simply not going to be collected. So for example, let's say that we've contacted Clayton and he's told us he's very unhappy with the work that we did and he's absolutely not going to pay. Or maybe we keep getting our bill returned to us, stamped, moved with no forwarding address. Or maybe we found out that Clayton got thrown in jail and has gone bankrupt, and for whatever reason, we realize that we're not going to collect that $200 from Clayton, and we're ready to just give up on it. In that case, we're going to write off Clayton's account. When you write it off, just like any other asset, when an asset loses its future benefit, we're going to reduce the asset and take that expired portion to some sort of expense. And when we're talking about accounts receivable, the expense account is called bad debt expense. So if we're going to write off Clayton's balance, what we would do in the journal is we would debit bad debt expense and credit accounts receivable for Clayton. And when we post that entry to the ledger, we would, like I said, debit bad debt expense, credit accounts receivable, 200, and we would also need to credit whatever customer we're talking about, in this case, Clayton. And in big red letters, we would probably want to indicate that this account balance is zero, not because he paid, but because we wrote off his account. That way, if Clayton comes in at some point in the future, wants to buys something else, we can look up his account and tell him, well, we're not going to sell to you on credit because you didn't pay us the last time. So, when you write off an account, again, you would reduce accounts receivable and take it to bad debt expense. Now that lowers the accounts receivable balance to 19.8. And if we were going to make financial statements right now, then the accounts receivable of 19,800 would show up on the balance sheet, and the bad debt expense of $200 would show up on the income statement. So, in summary, accounts receivable in the ledger represents the grand total of all of your customer balances. You're going to keep up with those individual customer balances in the accounts receivable subsidiary ledger. Constantly update individual customer balances as you sell items on account and as they pay you. Periodically, you can evaluate the quality of those receivables by preparing an aging of accounts receivable, where you spread out the customer balances based on how old they are. And if whenever you identify a customer balance that you're ready to just give up on, you would write it off and record bad debt expense for that balance that you're writing off. Okay, that concludes the introduction to accounts receivable aging and bad debt expense, and see you in the next video.